Welcome to Inspired Edinburgh, the home of powerful conversations. I'm Elliot Reeves, and my guest today is Colin McLean. Colin is founder and CEO of SVM Asset Management, an independent Edinburgh-based fund management group. You have more than 35 years investment experience and are widely regarded as one of the UK's top stock-picking analysts. You were elected to the Board of Governors of the CFA Institute in 2012 and are a past chairman and board member of the CFA UK. You're also a fellow of the Institute and Faculty of Actuaries and a chartered fellow of the CISI. You're an honorary professor at Heriot-Watt University, a regular contributor to financial publications, have been a guest on Bloomberg TV, CNBC, BBC TV and radio, and you frequently speak at conferences on the topics of investment, hedge funds and behavioural finance. Colin, it's an honour to have you here. Welcome to the show.
Thank you.
It's great to have you here. And I'm really interested, I have to say, in kind of diving deep in conversation with you. You have a very fascinating background and
Well, thanks. I'm looking forward to it.
Yeah, very much so. So, I mean, in the beginning, if we could start with, your early life and where you grew up and kind of what that overall experience was like for you.
I was born abroad. My father worked for Shell in Venezuela. However, I didn't spend very long there, so this was a very, very early stage, and most of my upbringing then was thereafter in Scotland, in Glasgow mainly, although subsequently I moved through to Edinburgh, so I spent most of my formative years in Glasgow.
Right, okay. And that's obviously where you studied as well.
Yes, I went to, naturally, my father was a lecturer at Glasgow University, and so quite a lot of the family was built around that, and that, particularly given I was interested in economics, that seemed a natural place to go. So
yeah.
I did consider other places, but I ended up thinking that Glasgow University had quite a good reputation in economics.
Mm-hmm. So when did your interests in economics and investments first begin?
I think the economics sort of naturally took me into investment, but I also combined that with economic statistics, and it was really in that area that I started work. So that is, I started work as an actuarial trainee and doing actuarial work. So that's quite sort of statistical and arithmetical really, and so on as well. And it was only after a couple of years of doing those exams I saw the opportunity in the life assurer I was in to maybe understudy the general manager in investment. And I think it's interesting that the investment world was quite different at that stage in the I suppose by then the late 1970s, and it wasn't so much of the sort of high-powered investment banking, or even that high-paid at the time, really, to be honest. It was much more something where a lot of actuarial people went into it. A bit more of a geeky thing, I think, really. It was calculating, the compound interest and other things. So it was, in fact, we didn't even value the portfolios at market value. So it was, sort of annually at book cost and so on.
Okay.
So it was a sort of world in which I thought investment was quite interesting and going to move in an interesting way, but there wasn't a huge amount of sign of that, to be honest, and it wasn't purely because the pay wasn't there, really,
Yeah. So was it something that you had an affinity with because it was a talent that you had? Was it something that you were quite good at?
Possibly then, yes. I did initially. I think when I started off, I was given a lot of responsibility, opportunity there, and yes, I did find ways in which I could apply what I knew and what I'd learned and so on into investment and into stock picking, and there was quite a lot of things just sort of emerging at the time, really. So it was a time when perversely, although it's only now that passive investment, index investing has got very big, in the 1970s and even into the 1980s, there was a very strong belief that the market was very efficient. The academic position was that it was perfectly efficient and you couldn't really do terribly well stock picking. And in fact, in terms of research. It was only with Robert Shiller in 1982 that he really sort of undermined that. He got a Nobel laureate a couple of years ago, but that it wasn't until the 80s that people started thinking that there was much more opportunity in investment, because the orthodoxy was this sort of there's nothing there to beat, there's nothing there to do. So I found that interesting. I suppose I hadn't really got a lot of experience with companies. I mean, all my family, and for that matter, just about all my relatives are in public sector, so it wasn't something that I was deeply imbued with in the family. And I meet plenty of people in investment that are like that it's not come particularly from any deep early indoctrination into the corporate world. It was quite a different world for my family altogether. But I did find it interesting, and I think half the route to success in something is having a general interest and a genuine curiosity about it as well. So that I did have, and that made me really work quite hard still at learning. I would say to anyone really at an early stage, invest in your education and do something you enjoy. But in particular, it's a very formative period in your 20s, and you really want to work quite hard at getting as much experience as you can.
Yeah, absolutely. That's great advice. What were your early aspirations when you started working, and how did your career sort of unfold?
I could see quite early on that the sort of way that life assurers did things, could give way to. I mean, already there were some unit trusts around, and that investment was by far the more interesting part, and ultimately potentially the more valuable part of the whole savings proposition. And so I moved quite early on after that to get the life assurer to set up unit trusts and to try and separate that out as a division. A lot of these things were, and including hiring women at the time and things like that. It was a lot of things I did then from the late 70s through to into the 80s that were not common at all then. At the time they were quite different. And the big life assurers at the time, the Standard Lifes and others, had very small unit trust operations, but they didn't see them as being as valuable because there wasn't the sort of margin in them. They're much finer margin businesses, and therefore you couldn't incentivize the sales of people as well. But they were actually a much simpler way to run people's investments. Not everyone needed life assurance. So the potential just for having more equity investment, investing in shares, and be able to do well in that. As the 80s and 90s unfolded, more and more people got aboard that. But I would say even up into the late 80s, it still wasn't the choice of many of the life assurers to go down that route. And I definitely got an advantage by setting up within the insurer a separate investment division and having some incentives and rewards around that. And I very quickly realised, though, that division became more valuable than the life assurance company. Had been around for 100 years, but very quickly the investment division was more valuable, just more profitable. And I realised within a mutual entity at that time, it was quite difficult to be rewarded for that. So it was quite it had outgrown, and I guess my own aspiration had outgrown that mutual life assurance environment.
Yeah. You I know that you worked with Sir John Templeton.
Yes.
You were managing director of the European operations there, and then in 1990 it was that you co-founded SVM. What made you decide that you eventually wanted to run your own organisation?
It happened in a couple of stages, and with some encouragement from others. I moved as an interim stage. I moved and became a CIO of a Chief Investment Officer at Scottish Provident, and was there a couple of years, and that involved running a much bigger fund and 50 people in bigger division within an overall organisation that had several hundred people, and so it gave me an opportunity just to see how things were done in a bigger way.
Mm-hmm.
But I also realised if I was going to set up my own business, there was a bigger talent pool in Edinburgh, and it was going to be a lot easier to set up here. So
Mm-hmm.
I think that was at the back of my mind when I came to Edinburgh then in the mid '80s, and I spent a couple of years of that, and then was headhunted by Templeton, and that was a sort of pure equity business, but in quite a global scale. It's remarkable that it was quite an early stage business, so it was quite valuable at the time, probably worth 400 or 500 million at the time, and was acquired thereafter by Franklin. But it got me to work with Sir John Templeton, who was based in the Bahamas, and with Tom Hansberger, both of whom now passed. But Tom Hansberger was based in Florida, running their business, and it gave me a lot to learn about global businesses and the way in which they launched funds. I helped them launch the Emerging Markets Fund in the UK. They didn't have. In fact, I helped them reshape the emerging markets proposition into what's really known today, because it was a much narrower type of business before. So it gave me this sudden exposure, really, to see even another level that equities could be done on this global basis, and the distribution could be done in a different way as well. So I think then in setting up my own business, you could certainly, count on the fingers of one hand the number of people who had in Europe, set up businesses. There was a couple, David Williams in Scotland, Gilles Frenet in Paris. One or two others had done it, but not too many had set up from scratch that type of business, even just at that stage. But Templeton has showed me it could be done, so I wouldn't be able to do it without all those experiences.
What were some of the biggest challenges that you faced in doing that?
I think a lot of resistance from competitors and others. I think there still wasn't. I would equally say that there was a lot of support at the time. Not just Scottish Financial Enterprise, but a lot of others were very pleased to see, say, Templeton come to Edinburgh, and then for me setting up. So I certainly wasn't without support and friends in that, but plenty of, if you go down a path less travelled, there's plenty of opposition and sort of naysaying goes with that as well. So but equally, don't do it if you can't take that, really.
Absolutely.
So that was just a little bit more of a challenge. But other than that, no, the regulatory stuff and other things weren't really a big issue initially. Just building up the initial critical mass, the initial clients, was important.
This is probably a question that will likely appeal to people that have more of an interest in investing specifically. But how would you describe your investment approach and your investment philosophy?
It's adapted a bit over the years, and I'd like to think I keep learning, not just about investment, but some of the framework. One of the things I did put a lot more effort in probably really from the late 90s into was learning more about behavioural finance and the impact of psychology. And so that's something that's also helped. I do a little bit less small company stuff than I did before, just because there's not the liquidity perhaps for what we're running. But it's still the same combination of financial predictions and understanding accounts, and as you build up experience, there's more of a framework for understanding the range of likely outcomes and looking for warning signals in companies and so on. But it's a combination of that and I guess a reading of character and of individuals and commitment and so on. So it's a combination of those things. So I suppose initially in investing it was much more based on valuation. There were prejudices against companies that were service companies, capital light, so there was much more of a market focus on traditional capital intensive ones, and they were the very ones whose balance sheets were being destroyed by what was high inflation at the time. So the market perception was that that more labour intensive skills related businesses, the assets checked out at 5 o'clock every night, and what did you own? But I could see, in fact, you could build a franchise around those things, and there was value in those businesses. As things have moved on, I suppose we're still trying to look at what is proprietary, what franchise is there, what kind of moats there are around a business, what the defence there is about the margins it's got. So I would say I'm less of a deep value investor, certainly not as Templeton was, but it's not as much value as it was either, because there are risks in that. So in the past, I was much more looking for companies with margins that were below their industry average and being remanaged or catching up. Probably now look much more for companies that have got an intrinsic franchise, some proprietary value that allows them to reinvest in that and sustain superior growth over a period of time. So a little bit more, because ultimately if you do get it right on valuation initially and buy something cheaply, that's a plus. But if you do own it longer term, unless you're trading those companies, a lot or every few years, ultimately your returns in the portfolio are going to converge towards what the underlying returns are in the company, and they might leverage it up a bit or whatever. They might manage to find some way of enhancing it. That generally doesn't persist either. So it's just within so thinking of companies as a business as the way to do it, rather than worrying too much about earnings per share. So that's always been my style, is to think, step back and think much more of them as businesses, which are, people like Warren Buffett are good exponents
Very
of
much
that.
so, yeah.
But as I say, it's surprising that there was that sort of disruption in new businesses emerging, I think, in the 80s, because we're back at that again just now, and I think it's a really exciting time now when there's lots of new disruptive business models coming along, and that really can pay off for a good analyst. Even a private individual as an analyst can find businesses that can potentially sort of beat the established bigger boys, suddenly big old brands, and loyalty to that is sort of breaking down. So I've always wanted sort of growing businesses rather than, I've never been one that's really been that enthused about buying old chemical companies and things like that.
What about tech investing?
I don't do pure tech investing. I don't think I've got the expertise for that. There's the big disruptive patterns now are tech is part of it, changing tastes are part of it. A good part of what gave me the opportunity to set up a business was the arrival of spreadsheets and other things. I realized I didn't need to buy lots of stuff to be able to manage my business on a PC, big thing at the time. It was, but that let you sort of run, scale down and run a business. So I realized you could use those tools. Again, there's new tools coming along now. But the key to a lot of businesses now is it's not just different technology. They're appealing to different tastes, and it's not just millennials. I think there's a broad-ranging change in tastes. So when you look at companies we own in portfolios like Fever Tree Drinks, it's a good example of something that has in a very short space of time sort of come almost from nowhere, dislodged long-standing, drinks providers on the back of a wave of interest in gin, but also on craft and different experiences. And you can just see how all of those things come together. And technology is not a big part of that. And there are other ones where there's a bit more on technology, but technology is letting a lot of new people come along with new business models. But they still have to get to a critical mass. They have to have something original to offer. But suddenly, a lot of old established businesses banks, high street, retailers, and so on, are all under relentless attack. And it's so it's partly technology and partly changing tastes.
Mm-hmm. Mm-hmm. Good answer. Really, very interesting.
Yeah.
I have to say, really interesting. This will probably need to be caveated by saying that if people are looking to invest, they should always consult an advisor or be aware of the risks in doing so. What are some of your sort of favourite businesses that you personally invest in, and why?
We like a lot of those businesses that are almost of unique business models. I mean, they are doing something a little bit different. A characteristic of quite a lot of them is that they're mid-capitalization, medium-sized business. Medium-sized can go up to 5 billion. It's quite big companies. Some of those are in the AIM market, which brings the alternative investment market brings additional risks. Some companies are choosing to stay on that because they don't really need to raise the money that that going on the FTSE maybe implies. So you get a number of companies that are on AIM that have business models that don't need much more capital, or they found ways of funding internally. So something like ASOS as a distributor, once you've built the online model, then it scales, much as I was saying with Fevertree. It's found a way of licensing out. It doesn't produce, so it licenses out.
Mm-hmm.
Burford Capital's another large AIM stock that has found a way of investing in litigation and so on, and it's found a way of using other money to help manage that and help scale that business up.
Mm-hmm.
The biggest holding we've got just now is Hutchison China Meditech, which is an AIM-listed company, but it has pharmacy products in China, but it also has a license for cancer research there and works with bigger companies. It's been able to use the funding out of the retailing product business, fund the research, and now it's got some potential cancer drugs that are progressing quite well on research. So each of those, they've got something quite special and different. So they need a lot of understanding, and we're fortunate to be able to meet the management over a period of time and get comfortable with that and the strategy.
Mm-hmm.
But they don't quite attract in all the bigger investors, so there's still something that active managers and analysts and even private investors can sort of research and find. So we quite like those ones. So a characteristic of some of the companies is that they're not overnight successes. They are doing something over a period of time that's special and sustainable, has some superior margins, and there may be some reason why, despite that maybe looking obvious to us, maybe because it's on AIM, other people don't want to buy it, or they still don't quite understand it. There's still something that puts them off, and lets that persistent superior return continue. And a lot of those are, they don't naturally fit in a sector. They're maybe just a combination of businesses or a particular business model that's just different, and that by itself is something of a barrier to analysis. People are just a little bit more skeptical, but that's where I think the profits are to be made.
Mm-hmm. Mm-hmm. What do you think makes a great investor?
I've met all different types and backgrounds and so on, so there's no formula or mold for that really. Most are curious, and I think that's a good analytical ability, because you do have to keep on gathering information and learning all the time. So being genuinely curious about what makes companies tick, and that includes very often these analysts, you sit in a restaurant and they'll count the number of covers and what the margin is, and they'll rarely go into a shop or business without sort of working out whether it's a good business and what the economics are. It's just and that just builds up your understanding. So that curiosity, patience, because this stuff does take time, and resilience. We're speaking at a time just now when markets are going through some volatility, as they call it, which generally means that stock prices are falling, and or you find individual investments you made don't turn out as you expect. So you need to be able to, sort of come back and, rebuild your performance, rebuild your confidence and understanding, or at times, admit you're wrong and realize before, something is a total loss or wipeout in a company, realize that your analysis is wrong or your timescale's wrong.
Yeah.
So I think that sort of pragmatism of accepting, when you're wrong, the resilience of riding through difficult times, the patience just to last, and initially the curiosity to keep learning.
Hmm. You wrote an article recently essentially talking about in 2018 it would be easy for investors to become complacent due to reasonably strong recent performance, essentially. So how do you avoid making emotional decisions when you're investing? And how do you avoid falling into the trap of being complacent?
It's difficult because emotion is very much part of what we do, and to some extent it's not all a bad part. The gut feel you have about something, instinct, is all a part of us understanding things. I think it's important. I still spend time on accounts analysis, and I think it's still quite important to look plainly at the numbers that you're getting in the company updates. Companies do put the best loss or spin on what they're delivering, or even on problems, and there's scarcely of these businesses that are being disrupted. Most of them are spinning out the issues or explaining it as something temporary or something you can deal with, and that in the past was what we heard from HMV and Woolworths, lots of those companies that ultimately couldn't turn it round. So you're surrounded every day with an awful lot of that spin and hype and so on in companies, and you need to make sure that you're looking at the numbers as well, and that you sort of strip out that hype. But the complacency, the disciplines are just, if I hadn't sold any shares in Hutchison China, which has tripled over the last year, I would have holdings of over 10% in the funds. That represents an overconfidence in an individual company that isn't prudent. So you have to sell some even as it goes up, to maintain a discipline as well. So I think having certain working in a team is helpful because other people can help keep you straight about individual or ask questions about companies. But that's another sort of aspect that's needed about is discipline, and some of the behavioural issues in psychology and investing is best dealt with by structure and framework, and deciding how portfolio is going to be structured, how your trading is going to be structured, and not trading too much, and all of those things. And over time too, understanding what your own personal weaknesses are. I deal with that with that pragmatism, for example. Very often, if something is going wrong, or there's a company announcement that's not what I expect, and maybe even the share price falls, but it's more if the information doesn't confirm my investment thesis, I may sell a third of it, and there's nothing magical about that, but it does then leave you with a smaller problem if it's wrong. If you're right, then it leaves you with plenty of opportunity still to make money, but it's part of the discipline of just stepping back a bit when things are not looking, right, or like you've been correct. So the framework for dealing with psychology is a number of routines like that, a framework and a discipline.
I'd imagine an enormous amount of introspection is required as well.
I think at the times when markets are difficult, the resilience and it is, a lot of investors and a lot of people in markets are quite smart people, and often intelligence is used to rationalize what you do rather than question what you do. So you're in a world, and companies provide you with that. So there's an awful lot of spin on things, and a lot of argument for in favour of things, and not enough questioning or or reversing of positions and so on. So
Yeah.
you need to you need to be pragmatic, and you need to use the additional information you get to question the investment. And there are some things that go wrong or don't deliver what you expect.
Mm-hmm. I found an article, funnily enough, it was published a year ago today, which spoke about, you were commenting on CEO remuneration for high-level FTSE 100 executives. And there was a quote from it, which I'm not sure to what degree this has changed in the last 12 months. I suspect it hasn't changed greatly. It says, total pay for FTSE 100 chief executives is now 150 times higher than pay for the average worker, which I find quite alarming. What are your views on CEO remuneration, and what do you think should be done in order to intervene with it?
I think, it's an issue not just for the UK. So governments in Europe and US and so on are gradually getting their minds around it, and there's there's other aspects of board structure and so on as well, that the diversity and so on that needs fixing too. So there's a lot of different initiatives, different rules. Some of the rules haven't worked so well. Now publishing more information starts to give more scrutiny. What I saw last year was the beginning of a lot more engagement by investors, and we're starting in the work I do to bring more responsibility, sustainability, stewardship into what we do, and stepping up engagement with companies. So I think that matters. The bit about incentives, it's not actually so much what they're paid, and that may grate in some people, but for multi-billion-pound businesses, in a sense, while it might look ridiculous for someone to be paid several million pounds or 20, it's not by that itself that's going to make too much difference to the investment over longer term. But it's the actual incentives that are built in that make the chief executives do things that aren't in the interest. So if you have a chief executive incentivized in a particular thing, he is going to focus on that, and that might mean that it might even mean some distortion of accounting or how things are represented. For companies in the past that have run into problems, say like Tesco, before the current chief executive, there were signs in the incentivization that it was producing a number of things and changing company behaviour. That additional taking of risks that we found with it. Same applied before to BP under the previous chief executive and so on as well. So even on big companies, and sometimes on big ones, it stops the company perhaps from dismantling or changing its structure if the chief executive is still incentivized in a division that he doesn't want to sell. I'm thinking of companies like Glaxo then as well, and again thinking of previous chief executives, but you can get a distortion of corporate behaviour, and you can get a distortion of corporate culture. You can, as we saw with ones like Tesco, you can create quite a poor corporate culture because the tone at the top very often sets behaviour elsewhere. So an incentive, and it overall can set quite a short-term behaviour. For drugs companies like Glaxo, the whole cycle of researching a drug, right through from beginning to end to production, maybe 12 years or so, but very little incentivization goes beyond 5 years, and only a small part of it. So for other companies, that short-term focus, and a focus on earnings per share, and on particular metrics, an awful lot of companies still focus on the share price performance, and that gets away from how the business is doing longer term. So the sort of short-termism of the time frame, the corporate structure, corporate behaviour, and the culture, are all influenced by just one or two incentives, and it may be the smallest part of remuneration, but people are awfully directed by those incentives. And that remuneration, even at a few million, might be a very small part of the business, but it does set a tone that's wrong, and I think that's where shareholder intervention, government intervention, and so on can all help. But I think the answer is to encourage much more disclosure of some of those relationships and some of those patterns, and just encourage more voting and participation.
I don't mean for this to sound like a leading question. It might well do. Why is capitalism a good thing?
I think it has been at the root of creating a lot of prosperity in the countries that have had more of it. Have certainly, in economic growth terms, delivered more for the most part. There can be arguments about how that cake is divided and where the benefits of growth most go. There's obviously that's something that governments and regulators and so on and investors can all intervene with to direct, but the actual focus on efficiency and growth and so on is does quite a good job of matching a capital up with the best returns and with the best managers of corporate managers. So I think the whole, and while there may be many might not want particularly to have a US structure, the fact is that we have these companies like Google and Facebook and Amazon and others. They have been created out of that. Previous generations have created GE and Ford and plenty of others, and so on as well. So even now we can see some of those, big creations coming out of there. Has to be said that China is creating some too, but creating them almost more as it moves. It's not a mixed economy; it's still a communist economy. But what I do see, and I've travelled even over the last 3 months to Vietnam and Thailand and other places, and it's amazing just what a little bit of market pricing and interest in directing capital, and it's gone there with communism and with controls, but a little bit of that is creating quite a lot of dynamism in the economy, and it's created in Vietnam. It's helped to create a new low-cost air carrier, that lets everyone travel from one end of the country to the other, cheaply where they couldn't before, and that's come because an entrepreneur has seen the opportunity there and challenged the state-owned company, and that's happened within a communist country, But so even in mixed economies or communist ones, the extent to which you start pricing opportunities helps a bit,
You touched upon this earlier, but I'm just kind of interested in the ways in which the asset management industry is different today than it was when you first started.
It's changed in quite a lot of ways, although the route of company analysis and stock picking and putting that into a portfolio and so on, a lot of that, the root skills are very similar. The skills needed are similar. The infrastructure around that to comply and manage risk and so on is all different. So there's a much stronger framework there. Some of that risk management is good and is helpful, and there's a lot more ability to use the technology to, even to understand your own behavioural issues and so on. There's a lot of technology that does that now as well. Partly for regulatory reasons, there's a lot more standardisation now of portfolios, and I personally don't think in performance terms that's necessarily helped, and as evidence that performance we've had in the mid-cap or medium-sized companies, which tend to be owned more by specialist active managers like ourselves and other boutiques, rather than the biggest life assurers and pension funds, which own more of the bigger FTSE companies. That performance difference is maybe because there's a little bit more flexibility and being applied to investment and less of trying to scale things up. So the scaling up, into big investment firms, I don't think Nestle has delivered better performance, although delivers better pay perhaps for people, better risk controls and so on, a framework there, that's good too. I think investment is in the process of moving a bit more into a polarisation between the very low cost index investment, what we call passive investment, that's just based on indices.
Yeah.
That is based on the indices being sort of right, in the sense that they represent an economy, or that the share prices are right and efficient, and yet those people that use those indices are not putting anything into researching those, they're relying on others to do it. I think a number of active managers think, well, why should we just research those and let these people have a free ride? And actually there's more interest a bit further down the size scale, and actually there's a lot more opportunity where you're not working in things that are priced, and these are broadly alternative investments, buying property, hedge funds, private equity, infrastructure. All of these, I would say to younger people looking for an opportunity really to exercise flair, there's a lot more opportunity where you can work with something where you don't have to accept market prices initially, and there's a lot more mispricing, and you can put your analysis to work. So I think the more talented active managers are moving into areas of the market where there are more opportunities and anomalies, and away from those sort of big companies and into some of the private interests as well. So I see that trend continuing in the developed world, in other areas. I was saying in China, Vietnam, and India. They're still looking to more mainstream companies and for them to list. Yeah.
What are some of the ways that you think that the industry might be disrupted over the coming years? And and I wonder as well, in terms of you deal predominantly with institutional investment, but how many of the younger generations are actually investing their money in managed funds?
Yes, probably. I mean, I wouldn't say there was necessarily many were doing it. When I was young, but it's a pretty important thing to do. And if you're not sort of doing it yourself, and I wouldn't say that a pension structure is always the best way of doing it. You can get more flexibility by perhaps investing in an ISA or something else that so there are different ways of building up a lump sum, which gives you some flexibility. Younger people can afford to take more risk. They've got a big long horizon, and so they can more ride through things. But putting some savings aside is important. Although, as I said earlier on, investing in your own human capital is a pretty important thing to do as well, and people should not distract from that. So, which may be still further exams, getting more experience, or other things. But that's the first best investment people can make, certainly in their 20s, even to early 30s. But starting, putting some money aside eventually for pension or other flexibility or career breaks or things like that, they should have that aside. So that's definitely worth having some separate savings for, and I would still say having some control over themselves rather than necessarily a big pooled arrangement. So there are risks perhaps in some of the in the US, people invest in some of these low cost index funds, and of course what they are buying now is a lot of investment into Facebook and Google and so on, and these have been remarkably successful. But if you're investing for retirement like that, you're making a big bet on 30 years or 40 years. And companies like Facebook already were seeing it's facing some decline in user numbers and changing the models.
Yeah.
It still hasn't really faced the big Chinese giants, the Tencents, Alibabas, and others that are there. So we don't yet know how that'll pan out. So that there's in finance, I think there are more low-cost investment models going to come along, and that would make it simpler for people to invest. Already, I think a lot of people will be familiar with some of the credit cards, things like Monzo and so on, which I find remarkably useful for traveling, and it actually gives you just a lot more control over what you're doing at lower cost. That's the danger, I think, for some of the investment, that people want this stuff. It's not just digital; they want it mobile, and they want that control over it. Not that you have to see how your investments are doing all the time, but I think people, it's the experience, and they probably do want more of an ethical and sustainable wrap around what they're doing as well, to feel good about it. So I think the disruption for investment is about moving it more into that area and making it more of an experience and more practical, and the access that people have to active managers or stock picking may just be part of what they do, but I think people will want some experience, some ownership, and some ready accessibility to what they do.
Yeah, I think you're right. Definitely. What do you think is the best piece of advice in terms of wealth creation?
I think if people do save, they can. I know it's people are not saving quite so much, but I think you can build up, assets over the longer term. So it takes a certain discipline that maybe goes against the millennial grain, really, to do that. There's no doubt. But I had a lot of flexibility at the time I set up business and moved through, just from investments I'd made in the 80s, and I did initially do that on borrowed money. I think I had a borrowing facility with a credit card, which I think they never expected people to actually use, but I went along to the bank manager, insisted, and did that. So an element of risk taking at a very, very, very early stage. But I'm not suggesting people do that. But I think making some savings certainly gives you an awful lot of flexibility, sort of not just for retirement, but perhaps at key stages where you maybe want to shift career or take time out or do some other course. I think it ultimately gives people a bit more control and ownership of their career, and how they integrate that career with the rest of their lifestyle is to have a little bit of a cushion there and have ownership of that. And over time that can be built up and can help people.
Many of the, I suppose, kind of success or personal development style books talk about the idea of putting basically 10% of your earnings away. Is that the sort of thing that you're talking about?
I would say so, and I certainly, if you do that in your 20s, it will build up over time. If you invest it well, it can grow a lot more. And again, for younger people, they're probably more in touch with some of the growing trends. I mean, I think even while the stock market may or may not carry on doing over the longer term what it's done in the past, but it's done that over a very long period of time. But even just within that, there are clearly a lot of incumbent older businesses that you probably don't feel. Plenty of younger people may feel that the oil giants won't outlive them, or will pass peak car, peak oil, peak high street retailer, and so on. So they can probably focus some of their investments on the things that are growing, or funds that look for that, and in other things that are going to grow more rapidly, or even in other markets. I mean, the growth rate in countries like 6% a year in Vietnam and some of these other places, is throwing up a lot of opportunities. So I think the growth may come in different parts of the market, different parts of the world in future, but I think the basic premise that there can be a return on savings, and if you put it aside earlier on, you can afford to take some risk with that as well.
Excellent. I've got a few questions. They're slightly kind of larger philosophical types of questions. The first of which is essentially about your purpose in life. I mean, what do you feel has been your kind of purpose?
I've been very fortunate that from a relatively young age, I've been able to pick the other people I work with and have a lot of control over that. Not everyone does, but I've always thought it was important to be doing what I enjoyed and to quite a reasonable extent to work with people that I want to work with and so on as well. So but even for those that go down a different career path, I don't think that's as a bad thing to do, and you spend a lot of time, and nonetheless at work, people have a lot more opportunities to mix and match things now. But I think they should, as far as they can, try and keep it something that they enjoy. I think there's much more understanding now about continuing education and personal development. Even if you do stay within one industry, I broadly have, although it's moved from insurance to investment, there have always been other things that have been there to learn, the behavioural finance. There's other things now and so on as well that I've continued trying to learn and have found useful in my job. But I think generally the behavioural finance psychology is useful in a lot of other things in life and so on as well. And I've tried to keep abreast of technology and so on as well, social media and other things. So I think there's a lot of things that you can continue to learn and might be useful. So I think putting that commitment. I've always done some other things, either on charity boards or working in the professional bodies that you mentioned earlier. I've done things with the Actuaries and so on as well, running investment conferences and so on. So a lot of those things give you different opportunities for development, for working with different groups and perhaps in a not-for-profit way or running other enterprises. So I think it all depends. Some people, it depends what time they've got free from, particularly for women in careers, from working with families, having time out. People have just got to work all that into their lifestyle. But I think there are ways of keeping your perspective broad and of keeping learning, and so I think that's it's been an important part of keeping that perspective and resilience through the career, because there certainly are periods in investment where you just don't want that to be all you do, really.
Yeah. Is there anything on reflection now that you would have done differently?
I think in terms of I certainly could have retired much earlier. I could have, and or changed my lifestyle more then. And I certainly have stepped back a bit. I enjoy investment too much to really want to have done that. But so from that point of view, I suppose I could probably have scaled back some of my activities, a little bit then, and broadened out, as I mentioned to you before when we're chatting, that I probably spend about a third of my time in other sort of extracurricular activities, which is broadcasting, writing, professional bodies, non-executive directorships, and other things that take me out of my day-to-day job, that are quite interesting and I enjoy doing. So I think that keeping that going, I could probably have stepped that up a bit more, earlier on. I did always have plans, which I'm now trying to fulfill in writing a book rather than just writing articles and academic texts and so on. And I could have maybe done that earlier. You know, those sort of things would be nice. But I'm a you know, not everything works out exactly as you plan, but that's you know, that's no bad thing. As I say, the resilience is you just really have to accept those things as they are. You know, there's only a certain amount you can plan in investment. Other than that, no, I feel, you know, quite comfortable with those decisions. There are, yes, other different routes I could have gone down. I don't think for me working, you know, for a big corporation was really my thing. I might have spent more time, I would say, travelling earlier on, because I've done much more of that in the last 10 years, and it's been a real privilege to not just travel but work with investment professionals in different places. I mean, in the last couple of months, I've been in Warsaw, Bucharest, Ho Chi Minh cities, you know, and so on. And I'm still fascinated by that and by just seeing how other people go on with their lives and what the opportunities are there. And I sort of, you know, I do think that maybe after people invest in their education and development early on, I would say really get some travelling in while you're in your 30s and 40s and so on, and try and do it in a level in which you can really connect with some different lifestyles and ways of the world. I think that ultimately does help a lot.
In what way do you think travelling has impacted your horizons or your worldview?
I think I see a lot of investment opportunity in some other parts of the world. I also, you know, understand a bit more some of the constraints that they operate in. So that growth's not coming, you know, immediately or not without problems. So it does open up horizons, but I think also gives a better perspective on life here. You know, I mean, you know, we talked earlier on about capitalism, and you can see that there's an awful lot of, you know, our life here is about that. Having we you know, spent last summer, it's over 3 weeks, you know, around Thailand and so on, and you start to you see that outside the main city, you know, there are plenty of places there where people have a good lifestyle that's a lot less material, you know, in a way than we have, but is nonetheless, I think, in some ways an enviable, you know, lifestyle too, you know. And for that matter, you know, parts of India and so on, I find enviable as well. I would say there's a richness of culture in some of these countries, and I think there's a lot to learn from people's approach to life, you know, there as well. I think I would characterise, you know, what I see in particularly in places like Taiwan and so on as being you know, very dignified individuals in the sense of their mutual respect and self-composure and so on. So I think we move very fast and sometimes have poor relationships, you know, I think in the West and I think in some other countries, not just the pace of life, but the approach to life and to individuals. I think I think had I travelled earlier, I might have learned much more of that. Yeah.
How would you like to be remembered? What would you like your legacy to be?
I'd like to think, I mean, away from family and other things, because clearly that's an important part of what's left. But you know, I have, in the work I've done, particularly within the investment profession, tried to progress. I've just finished writing some material for them on professionalism and ethics, and I've tried to change I think the organisation's approach overall to making investment globally more of a professional with behaviour standards and ethics globally, I think there are signs that some of that is taking root, and I see a big appetite. As I travel around, I see that is what many young professionals want. They want to be in an industry that is going to make a difference, that's going to change things. They want what they do in investment to help improve people's lives, as I say, pensions and savings can do, but also to improve the growth of their country. And for many of these countries, where if they can start to price some of the capital and opportunities, they will attract more inward investment, and that will help their country's growth. So I see a lot of professionals have a genuine interest in seeing what they can do for society with what they've learned. And I think if I've been one of those who've helped contribute to embedding within all that we're teaching on investment skills, that it is still got to be professional and ethical, and that it is not something that's detached from society. It's part of how society grows. I think that's been an important thing for me to be contributing to, and I'd like to think that I've helped make a little bit of change in that.
Yeah, I think that's fantastic. I think it's admirable. Excellent.
Thank you.
What's the best piece of advice you've ever received?
I don't know. I get a lot of, with different people that I've worked with, like Sir John Templeton, I get a lot of good advice. He certainly always told me that, when you interview companies, you just trying to. He always said company managements knew much more about their own business than you will ever know, and so you're always going to get smarter answers. Just trying to, pick their brains in individual things. You're always going to be so impressed with that. So, I think I've put Sir John in the sort of behavioural investing camp overall, but he did give me some very good insights on behaviour. My father always said to me, one of the phrases he used was noblesse oblige, which he didn't mean that came from any particular nobility, but he did mean that if you had any, and it wasn't just the privilege of your knowledge or other things, but if you have an opportunity to do something, you really are obligated to do it. That you have an ongoing obligation to use not just whatever talents, but opportunity and relationships and other things. You should use them for good, and if you're in a position that others are not to make a difference, you really, you have to step up. So I suppose I do believe that there's an obligation, comes with whatever you believe that your position or abilities or things are, to think that you have to sort of make a difference and do the right things. So I suppose that has encouraged me never to feel I should be a bystander in something where I should actively look at whether the opportunity is there for a reason, or whether if I'm uniquely placed to fill that, I should step up.
How do you define success?
There's little point in viewing that just in financial terms. I think I think people have to be comfortable. People are not going to be happy all the time what they're doing. That's maybe a false goal. But I think people success is if you are comfortable with what you've achieved. I don't mean comfortable in a financial living sense, but I think people have to be comfortable in their own skin. They have to.
Yes.
So I think having that sense of them. I think being comfortable with their own identity and feeling that I do think for everyone, authenticity is what matters, and I think you can define that in different ways. But I think people sort of have to feel they're authentic, that what they're doing represents some sense of personal mission or standards that they've set, but they have to feel that there are characteristics that they have that represents their authenticity, and be true to that in all they do. So I think a lot of the key goals really have to be, and it's become much more a thing now that you have to manage that online and everything else. But I think in their lives, people have to be authentic and stick to those aspects of their personal mission and character that they think best define them, and stick to that.
If you had the opportunity to speak to your 20-year-old self, what would you say?
I probably don't worry so much about things, in a sense. I'm not a natural worrier, but I think people can be comfortable with a lot of different life paths that come out. Obviously, you should do as much as you can to intervene them, but I think it's a lot easier when you're younger to think of things being a single career goal or single path, and actually deviating from that path doesn't matter, quite so much, and may create a different version of you in future, and that includes whether people do voluntary work, take time out, do further education, shift career, or other things. I think it matters a lot less to see things in that linear way, because you probably end up feeling comfortable, at the end of the day with a lot of different, so you've got to feel comfortable with your own choices. But you probably, I think there's a lot more choice. I certainly didn't feel that, in the early stage, that if I wanted to go and set up a business or everything else, I could deviate too much. But I see plenty of people who have travelled or spent quite a bit of time working abroad or working in quite a different area or whatever, and they've ended up as peer, investment professionals or in interesting roles and so on. So I think there's a lot of other different routes end up the same way, and I think people probably have more flexibility and more choice earlier on than they really think they have at the time.
If you could change anything in the world, what would it be and why?
That's a tough one. I think a lot of countries at the moment feel let down by politicians and by governments, and there's an overall questioning. I think we will see a questioning over the next few decades about democracy and whether it delivers the result people want. So I suppose I think an awful lot of the issues that there are about distribution and poverty and other things, sort of come from whether we can get leadership, political leadership that will properly reflect what populations want, and if we can get populations together to try and broadly want some of the same things or find out what they do have in common that they want. So I think the big challenge is really making democracy work. If we can make that work, we could fix a lot of the other things that are there, and if we could get the right politicians to show true leadership, then I think we, as a society, we could work our way out of some of the problems we've got. So there seems to be a gap between the direction we go in, and some of those problems come from that, and what people really want, and it doesn't seem to sort of join up in the particular version of democracy that we have in the West.
Great answer. Colin, it's been fantastic speaking with you. I've thoroughly enjoyed it, and some of your answers are absolutely brilliant, really, really good. So thank you so much for your time.
I've enjoyed that too, thank you.
Great, cheers.